Welcome to Finance Stories, your essential guide to navigating the dynamic world of finance. I'm your host Vijaya Sai, and today we're zooming in on the pulse of the Indian market, the Nifty 50. As of July 15th, 2025, Nifty stands at a significant 25,195, and with its weekly expiry just 2 days away on July 17th, understanding its current state is more critical than ever. Let's begin by setting the stage with the broader market indicators. We're observing a relatively calm environment, with the India VIX, our volatility gauge, hovering at a low 11.82. This suggests that market participants aren't anticipating massive swings in the immediate future. On the economic front, the June CPI inflation has cooled to an impressive 2.10%, which is great news, indicating price stability. Looking ahead, India's projected real GDP growth for 2025 is a healthy 6.2%, painting a positive long-term picture. However, beneath this calm surface, there's a fascinating institutional tug-of-war at play. In July, we've seen foreign institutional investors, or FIIs, turn into net sellers. Looking at the data, FIIs have pulled out Rs 5,155.68 crores from the capital market, Rs 3,537.76 crores from index futures, and Rs 3,242.35 crores from index options. This sustained selling pressure from foreign funds would typically lead to a sharp market decline. But here's where the domestic strength comes in. Domestic institutional investors, or DIIs, have been robust buyers, injecting Rs 3,282.95 crores into the capital market. This strong domestic buying is crucial. It's absorbing the foreign selling and preventing a significant market correction, leading to the current phase of consolidation. We're also witnessing a clear sectoral rotation. Money isn't flowing uniformly across the market. Sectors like IT are facing earnings pressure and seeing capital exit. Conversely, outperformers like realty and healthcare are attracting fresh investments. This rotation highlights that while the overall index might be consolidating, there are still underlying pockets of strength and opportunities for selective plays. Now, let's talk technicals. The Nifty is currently trading within a critical buyer's zone. For intraday traders, understanding these levels is paramount. We've identified key resistance levels, the immediate one around 25,250, followed by 25,300, which acts as a strong psychological and prior consolidation point. On the support side, 25,150 is immediate and critical, with stronger support around 25,100 and 25,000, which also aligns with Fibonacci levels. A sustained break below 25,150 could trigger further selling, while holding this level could initiate a bounce. Our intraday probability outlook suggests a higher chance of flat to slightly bearish movement. Given the conflicting technical signals and the balanced institutional flows we just discussed, a strong, trending move in either direction is unlikely in the immediate term. This makes range-bound strategies particularly favorable. The optimized strategy: bear call spread. So, what's the best approach to capitalize on these conditions, especially with the July 17th expiry looming? We're recommending an optimized low-loss bear call spread. This strategy is specifically designed to maximize your profit potential while strictly minimizing your loss, making it highly efficient for a consolidating market with very little time left until expiry. Here's how it works. Action: you would sell the 25,250 call option, expiring on July 17th, 2025. You're selling this closer to the immediate resistance, aiming to collect a higher premium with the expectation that Nifty will stay below this level. Hedge: simultaneously, you would buy the 25,300 call option, also expiring on July 17th, 2025. This acts as your crucial hedge, capping any potential losses if the market makes an unexpected upward move. This creates a tight 50-point spread, 25,300 minus 25,250. The benefits of this optimized bear call spread are significant. Low and defined. Loss, this is its core advantage. Your maximum potential loss is inherently limited, providing crucial risk management. You know your worst-case scenario upfront. Profits from time decay. With only 2 days until expiry, time decay, or theta, will rapidly erode the value of these options. As the seller of this spread, you directly benefit from this decay if Nifty stays below your sold strike. High probability of profit. This strategy is designed to have a higher statistical probability of success, estimated around 65 to 70%, as it profits from the market staying within a defined range rather than needing a strong directional move. Improved risk-reward ratio. By carefully selecting these tighter strikes, this strategy aims for an attractive MAR 10.1.2 risk-reward ratio. This means for every 1 unit of risk you take, you are aiming for 2 units of profit, making it a highly efficient use of capital. Trade Summary Dashboard, 5 lots. Let's break down the financial implications for trading. 5 lots of this optimized bear call spread, giving you a clear picture of the capital, charges, and potential net profit. First, the capital required. For a bear call spread, the margin blocked by your broker is typically equivalent to your maximum potential loss. For 5 lots, with an estimated maximum loss of $1,650 per lot, your approximate margin blocked would be $8,250. This is the maximum capital you're putting at risk for this specific trade. Next, let's consider the estimated charges. These are crucial for calculating your net profit. For 5 lots, we estimate total charges to be around $135. Let's quickly break that down. Brokerage, entry and exit, approximately $80. STT, securities transaction tax, around $20. Exchange transaction charges, roughly $15. SEBI turnover fees, a nominal $1. Stamp duty, another nominal $1. GST, 18% on brokerage, plus ET plus SEBI, approximately $18. These charges are estimates and may vary slightly based on your specific broker and the exact premiums at the time of trade. Your potential net profit for 5 lots would be approximately $4,115. This highlights the efficiency of the strategy, allowing for a significant return relative to the defined risk. When to buy and risk management. Given the very short expiry on July 17th, precise entry timing is paramount for this strategy. The ideal entry would be when the Nifty 50 approaches or tests the 25,250 to 25,300 resistance zone and shows clear signs of struggling to break above it. Look for specific candlestick patterns or intraday price action that confirms a reversal or consolidation at these levels. It's crucial to enter when the market exhibits signs of continued consolidation or a slight bearish bias on an intraday chart. Avoid entering if there's strong sustained bullish momentum that breaks above these resistance levels. Before you execute the trade, always perform a quick premium analysis. Verify the premiums you would receive for selling the 25,250 call and pay for buying the 25,300 call. Ensure the net credit received aligns with our estimated maximum profit and justifies the risk. Remember, premiums will fluctuate rapidly as expiry approaches. For a July 17th expiry, entering the trade earlier in the remaining trading sessions, perhaps during the morning session on July 15th or 16th, allows more time for time decay to work in your favor, provided the market direction remains consistent with our outlook. Most importantly, practice strict risk management. Always have a predefined exit strategy. If Nifty decisively breaks and sustains above the 25,300 level, consider exiting the position to limit losses, even if it means realizing a loss before expiry. Do not hold the position if the market moves strongly against your outlook. In summary, the Nifty 50 is in a consolidation phase, influenced by balanced institutional flows and specific sectoral rotations. The optimized low-loss bear call spread offers a smart, defined risk approach to navigate this market, aiming for significant profit potential with minimal downside, especially with the July 17th expiry. Thank you for tuning in to Finance Stories. If you found this analysis helpful, please like, share, and subscribe to our channel for more in-depth market insights. Remember, the information provided here is for educational purposes only and not investment advice. Always consult with a qualified financial advisor before making any investment decisions. Happy trading, and we'll see you next time.